There's a mathematical pattern hidden in financial history that's predicted every major economic collapse for the past 2 centuries. And right now, in 2025, we're sitting exactly where the formula says the next catastrophic crash will begin. October 24th, 1929, Black Thursday, the day that triggered the Great Depression and wiped out fortunes overnight. September 15th, 2008, the collapse of Lehman Brothers that sent shockwaves through the global financial system and destroyed millions of lives. These weren't random events. They weren't unpredictable black swans that caught everyone off guard. They were mathematical inevitabilities that followed a precise timeline that economists have been tracking since the 1800s. The pattern is simple yet terrifying. Every 18 years, the housing market reaches a peak and crashes. Every 90 years, that housing crash coincides with a massive stock market collapse that reshapes civilization itself. 1929 plus 90 equals 2019. But the crash didn't happen in 2019 because unprecedented government intervention delayed the inevitable. The Federal Reserve printed trillions of dollars and artificially suppressed interest rates to levels never seen in human history. They didn't prevent the crash, they amplified it. Now the mathematical sequence is catching up. The delayed crash from 2019 is combining with the natural 18-year housing cycle peak of 2026. 2 devastating forces converging into what could be the most destructive financial event in modern history, and the warning signs are everywhere if you know how to read them. Let me show you exactly how this pattern works, and why 2026 isn't just another prediction. It's a mathematical certainty that's been building for decades. The 18-year real estate cycle was first documented in the 1870s by American economist Henry George. George studied land speculation patterns and discovered that real estate markets moved in predictable waves that lasted roughly 18 years from peak to peak. He wasn't guessing. He was tracking actual data across multiple centuries and multiple countries. The pattern held in America, Britain, Australia, and every developed economy where accurate records existed. Here's how the cycle works. Real estate prices rise gradually for about 14 years. Speculation increases. Credit becomes easier. Everyone believes property values will continue climbing forever. Then comes a mid-cycle correction around year 14 or 15. Prices dip slightly. Some speculators get scared and sell, but the underlying economic fundamentals remain strong, so prices recover quickly and climb even higher than before. This recovery creates dangerous overconfidence. The brief correction convinced everyone that real estate always bounces back. Lending standards relax further. Speculation becomes rampant. Ordinary people leverage themselves to buy investment properties they can't afford. Builders construct more homes than the market needs. Banks create increasingly exotic financing products to fuel the frenzy. By year 17 or 18, the entire system is built on leverage and speculation. A single shock, whether it's rising interest rates, an external economic crisis, or simply the realization that prices have reached absurd levels, triggers a cascade of selling. Over-leveraged speculators are forced to liquidate. Banks that made reckless loans face massive losses. The crash that follows isn't just a correction, it's a complete collapse that takes years to recover from. This pattern played out perfectly in the lead up to 1929. Real estate speculation in Florida and other markets reached fever pitch in the mid-1920s. When that bubble burst in 1926, it weakened the entire financial system just as stock market speculation was reaching its own peak. The combination created the perfect storm that became the Great Depression. The same pattern repeated before 2008. The real estate boom that began in the 1990s accelerated through the 2000s. Subprime lending exploded. People with no income bought multiple investment properties with zero money down. Banks packaged these toxic mortgages into securities and sold them globally. When the housing market peaked in 2006 and began declining in 2007, it triggered the financial crisis that destroyed the global economy. But there's a deeper pattern underneath the 18-year real estate cycle. Every 90 years, the real estate crash coincides with a massive stock market bubble that's been building for decades. This creates what economists call a super crash. Not just a recession or even a depression, but a complete restructuring of the economic system. The 90-year pattern emerges from something called the long wave cycle, first identified by Russian economist Nikolai Kondratiev in the 1920s. Kondratiev studied economic data going back to the 1780s and discovered that capitalist economies moved in long waves lasting 50 to 60 years. Each wave consisted of roughly 30 years of expansion followed by 20 to 30 years of stagnation and decline. But Kondratiev's work was incomplete because he was executed by Stalin before he could fully develop his theory. Later economists refined his model and discovered that the waves actually last closer to 90 years when you account for the full cycle from the beginning of one major crash to the beginning of the next. The mechanism behind the 90-year cycle is debt accumulation. During the expansion phase, debt grows faster than the economy. Governments borrow to fund wars and social programs. Corporations borrow to expand and acquire competitors. Individuals borrow to buy homes, cars, and consumer goods. For decades, this debt-fueled growth creates prosperity and rising living standards. But debt compounds exponentially while economic growth remains relatively linear. Eventually, the debt burden becomes so large that an increasing percentage of economic output goes to servicing interest payments rather than productive investment. Innovation slows. Productivity growth stagnates. Inequality increases as financial assets appreciate faster than wages. The system becomes increasingly fragile. More and more economic activity depends on continued credit expansion rather than actual wealth creation. When something finally triggers a loss of confidence in the credit system, the entire structure collapses. Debt that seemed manageable during the boom becomes impossible to service during the bust. Mass defaults cascade through the financial system. Banks fail, currencies collapse. Decades of artificial prosperity evaporate in months or years. This is exactly what happened in 1929. The 1920s had been a decade of unprecedented debt-fueled speculation. Stocks were bought on 90% margin. Real estate speculation reached manic levels. Corporate debt soared as companies borrowed to fund expansion and stock buybacks. When the crash finally came, it wiped out not just the speculators, but the entire economic system they had built. The same pattern repeated in 2008. The decades leading up to the crisis had seen explosive growth in government debt, corporate debt, and household debt. The entire economy had become dependent on continuously expanding credit. When the housing bubble burst and credit markets froze, the over-leveraged system collapsed. Now we're approaching the next convergence point. The 18-year real estate cycle that peaked in 2007 should have peaked again around 2025 or 2026. The 90-year supercycle that crashed in 1929 should reach its next peak around 2019 to 2026. Both cycles are converging exactly where the mathematical model predicts the next supercrash will occur. But here's where 2026 becomes uniquely dangerous compared to previous crashes. The government response to 2008 created conditions that have never existed before in financial history. When Lehman Brothers collapsed, central banks around the world coordinated the largest monetary intervention ever attempted. The Federal Reserve dropped interest rates to zero and began purchasing government bonds directly. They called it quantitative easing. This intervention didn't solve the underlying debt problem. It made it exponentially worse. Government debt that was already unsustainable in 2008 has now reached levels that dwarf anything seen during wartime. Corporate debt has exploded as companies borrowed cheaply to buy back their own stock and fund acquisitions. Household debt has returned to pre-2008 levels despite wages remaining stagnant for most Americans. The total debt burden across all sectors of the economy is now roughly 3 times larger than it was before the 2008 crisis. But the interest rates supporting this debt mountain are artificially suppressed near zero. The moment rates normalize to historical averages, the interest payments alone will consume an unsustainable portion of economic output, and that normalization is already beginning. Inflation that central bankers insisted was transitory has proven persistent and embedded throughout the system. The Federal Reserve has been forced to raise interest rates from 0 to over 5% in less than 2 years. This represents the fastest tightening cycle since the 1980s, and it's happening while debt levels are at historical extremes. The mathematics are brutal and unforgiving. Every percentage point increase in interest rates adds hundreds of billions in annual debt service costs. Companies that could comfortably service their debt at 2% interest are facing bankruptcy at 7%. Regional banks that loaded up on long-term government bonds when rates were near zero are sitting on massive unrealized losses as those bonds have lost 30 to 40% of their value. We're already seeing the early casualties. Silicon Valley Bank collapsed in March 2023 in the second largest bank failure in American history. Signature Bank failed the same week. First Republic Bank collapsed 2 months later. These weren't isolated incidents caused by mismanagement. They were mathematical inevitabilities caused by the impossible combination of massive debt and rising interest rates. But the bank failures are just the beginning. Commercial real estate is entering what can only be described as a death spiral. Office buildings across America sit 40 to 50% vacant due to permanent shifts toward remote work. These properties were financed with mortgages at 3% interest rates. Those mortgages are now maturing and need refinancing at 8 or 9% rates. The mathematics don't work. A building that barely generated enough rental income to service debt at 3% is completely insolvent at 8%. Owners are walking away from properties worth hundreds of millions of dollars. Brookfield Asset Management, one of the world's largest real estate companies, has already defaulted on multiple office towers, simply handing the keys to lenders rather than continuing to service impossible debt. Over $2 trillion in commercial mortgages come due between 2024 and 2027. A significant portion won't be refinanced because the properties can't support current interest rates. The wave of defaults will devastate regional banks that concentrated their lending in commercial real estate. Bank failures will accelerate through 2025 and 2026 as loan losses mount and depositors lose confidence. This creates the perfect setup for the housing crash portion of the cycle. Regional banks are the primary source of residential mortgages outside of government programs. As these banks fail or pull back from lending due to commercial real estate losses, mortgage credit will tighten dramatically. Home buyers who could qualify for loans in 2024 won't be able to get financing in 2026. The mathematics of history are absolute. They don't care about hope or politics or wishful thinking. 1929 plus 90 equals 2019, delayed to 2026. The 18-year real estate cycle converging with unprecedented debt levels and rising interest rates. The pattern has repeated for 2 centuries because human nature never changes. Greed, fear, leverage, and collapse. The only question isn't whether the crash will happen. It's whether you'll see it coming and position yourself accordingly. Because when the convergence completes, when both cycles reach their mathematical conclusion, the world that emerges on the other side will look nothing like the one we know today.